The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm the host, Brian Akers, certified financial planner practitioner and president and founder of Akers Financial Group, and we welcome you to our Winning in Retirement radio podcast. Here with me today is Alex Monk, a certified financial planner practitioner, also been with Akers Financial Group for 14 years now. It's been good, Alex. How are you doing today, Alex?
I'm great, Brian. Good to be here.
That's cool. Well, I think it's exciting to get here to do a tax show. But I was going to call it a tax show, but I want to call it a never tax show. So today's topic is to be called Never Pay Taxes Again. Today's show is Never Pay Taxes Again. Is it possible to never pay taxes again? If you use some of your money to pay tax now, you might never have to pay tax again. And we're going to try to cover that because it's huge. The show's going to be huge. And I don't know any other words that for huge to use for that.
I mean, so many people come in and they're like, I don't want to pay so much in taxes. Like, That's their big thing, right? Like, how many people do you meet with? Like, everyone's key topic is like taxes.
Yeah, from the first time the person gets a paycheck and the taxes are coming out when they see that reality to the idea of as you make more and more, they take more and more and more. It's an escalating tax, understanding that you have to pay tax on money and you got to figure out what's the right strategy for you. And so today's show is really trying to design a way that fits for you and your exact situation where you are right now to be able to create money that would be tax-free to your future, tax-free when you take the money out, tax-free when you give it to your kids and family. That's what we're going to talk about today.
That's huge, right? Because like so many people spend their careers working and they try to avoid taxes.
Absolutely.
And we're going to say to you today, well, maybe you want to pay them now and never again.
It's just definitely something you got to look at. So one of the things you got to do is this. You got to think about your situation. And we can use different examples of clients. That's going to be fun through today. We get to tell stories about our clients. I'm going to just try to explain my retired clients. My retired clients, when they come in and in their 60s, before they got to start taking money out of their retirement money, sometimes there's years where their income goes low because they're living off of savings and don't really need much extra. They're sort of just being mellow in retirement and really enjoying it. And the reality is like, what do we want to do about their taxes? And I look at it and I say, well, we can actually do Roth conversions while you're not bringing in too much money. And before RMD starts, we can take that money, convert, and that'll lower your future taxation. And the idea of a Roth IRA will actually be where we pay tax now and never again. And that's a great concept, and it actually helps them in many, many ways.
Yeah, and like in those years, they may be paying little to no taxes at all.
Especially if they postpone Social Security, use some of their savings, or use their dividends and interest they're already paying tax on. And if they keep things under, $40,000, $50,000 of income, you'd be able to slide in under standard deductions and pay very little tax.
Yeah, and like that's a great thing because if you like project out their future income, like they could be 75 and at the highest tax bracket of their lives.
And many great savers, that's exactly what's going to happen, especially if you're a 401k millionaire. 401k millionaire is what I would tell anybody that's building for their retirement. You're going to have to be a 401k millionaire to live off just that if you don't have pensions or anything. So Today's show is truly for us to talk about Roth IRAs. Roth IRA and how that works. Hey, Alex, give us a basic, what is a Roth?
So a Roth is a type of individual retirement agreement where you put in money that's already been taxed, meaning you've paid your tax. So it either comes out of your checking account if you're able to make contributions, which is, has caveats, income level based on age, stuff like that. Mm-hmm. Or you paid the tax through your paycheck and put it into a Roth version of 401k, something like that. And so that money grows tax-free and it comes out tax-free.
Right. Now, coming out tax-free has some qualifiers. So generally, it goes like this. If you put money into a Roth, that's your contribution. You need to track that on your tax form. And that's through an 8606 form. And so if you're under 59.5 and you want your money back to use for something else, you can take the original cost basis back out tax-free, because it was always, it was always your after-tax money anyway. Now, as that money grows over time, there is a 5-year rule, and you have to be over 59.5 if you want that money, the growth, to be tax-free.
Right, the earnings.
The earnings, yes. Earnings is when things go up. Just in case people wanted to know what that was.
Right, and so you want your Roth money to typically grow the fastest.
Absolutely. How you invest a Roth, we think, is a very important thing to do. Having a Roth into like a CD, we don't feel is proper, because we like it to grow at a much faster rate than that. Right,
you would want money that you're never going to pay tax on to be the most aggressive, right? Because you have the longest timetable before you want to take it out,
right?
Hopefully.
Yeah.
You can always get your contributions, like you said, but you want that money to grow as fast as possible.
Absolutely. So a Roth IRA is an account that is individual in nature. So that means if there's a husband and a wife, they would actually can have two separate ones and need to have two separate ones for him, one for her. And the idea is that a Roth is set up in your name as a Roth IRA. A Roth IRA is a wonderful way of saving money for you. The younger you are and the longer we have to let it grow, it becomes an automatic recommendation in many cases.
Yeah, so it doesn't really make sense to me, Brian. Why would the government want to do this?
Well, let's think about it. So 1998 was when the Roth IRA was basically created and put into law. Do you know what happened that year, Alex?
I think I do.
Yeah, of course.
Of course.
You just heard me say it a week ago. When we were doing one of our public events, I told this little story about Alan Roth out of Delaware. That's who they named this law after. But there was also the last year the federal government balanced their budget for the year was the year they did Roth. And the idea was if you take money out to do a Roth or convert money from IRA to Roth, you pay tax in that year. Isn't that wonderful for the government to get taxed now?
They love that, right? Think of all that money that they're not getting to tax you on.
Yeah, so we call on the show, never pay tax again. That means pay tax now and never again. So the federal government goes, pay tax now. You got my attention. And hey, let's do some more. And the Secure Act 2.0, they actually have a law in there that someday soon the 401ks will start to incorporate, where your matching from your employer could actually be converted to Roth also by you paying tax now.
More taxable income, and they got to love that.
And the sad part is down the road, they're not going to get the tax on the growth. It's going to be tax-free.
Well, that's how these things work, though, right? They got to fix the problem immediately. Mm-hmm. I mean, our deficit is probably going to go up a couple million while we do this radio show.
Actually, about $1 million. Absolutely, you're right. Oh my goodness! The thing about how fast it raises by $1 trillion is a little over 90 days now to go $1 trillion in our debt currently.
So what does that mean? Higher taxes in the future? It has to.
It probably does mean higher taxes, depending on how they try to handle it. The idea right now is we feel that under the Tax Cut and Job Act that started back in 2017, and it runs all the way through the end of next year, which is the end of 2025, what happens is that law gave us lower tax rates, gave us money at a cheaper rate. If you're in the 15% bracket, now you're 12. If you're in 25, now it's 22. The 39.6 is now 37. It's all across the board, a few percent less. And then they also changed the itemized and standard deductions to where everyone's doing standard deductions.
Yeah, so effectively, depending on your situation, but you're paying 2 to, sometimes 3% less, somewhere in that range.
That's generally very true. Depending on how high income you have, and if it's 2 income, you could at least say 1 to 2%. The thing is that the law actually sunsets. So the sunsetting of that law means it goes back to where it was 2017, which would be back to those rates. That's if they don't do anything. The government and their new decisions into next tax year are all very important to see how to plan. But we feel like 24 and 25 is the year you must look at paying tax now and never again, and see how that fits in your portfolio. And we're going to give you many reasons to do that today.
Absolutely. And so with the laws, we know they're going to change. Mm-hmm. We know they're at least going to get a little bit worse as far as taxes going up.
Sure.
But if things are going to change, what a great time for them to increase them a little bit higher.
I think paying taxes is okay this year. I really do. I think this year and next year are the best 2 years that we're going to see in the future.
And I meet with people, and we talk about this all the time, and they're like, well, what's the downside? And I say, well, the downside is you've already paid your tax.
Yep.
Like,
that's over.
It's done.
Yeah. The hard part is those that have pre-taxed their whole life, and you have a 401k. Like I've seen one recently was $3.8 million, and then I said, well, it's not your $3.8 million. The sad part is as we pull this out, if we can keep it under the 32% bracket and you're paying 24 and H, that's 32% of that goes to Maryland and the federal. You got to understand that not all that money is yours because you did pre-tax. And then we got to talk to everyone that's younger. Does that make sense to pre-tax it, or should you pay tax now?
Well, and the tough part is like that person was probably deferring when they were at a tax rate in the 20s.
Right.
And saved so well. And now they've created this huge future tax problem with, this huge variable of what are things going to be in the future.
We have so many stories to tell you, so many examples to give you on why a Roth needs to be considered in your portfolio. So what we do is this. We talk about the idea, pay tax now, never again. So that idea is more than just a calculation on your taxes. It's about what's your plan today, your plan in the future, what is your bracket today, and what's your tax bracket when you retire. Does it make sense to pay tax? If you're going to be in the same bracket now and in retirement, which I think is a fair thing to assume because people would like to keep the same standard of living, why not pay tax now? And then as it grows, when it comes back out, we won't have that problem. There's so many reasons to do that and so many ideas that we'll be getting to you throughout the show. Remember this, that the best part of retirement is getting your time back. You decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Why pay taxes now? We will explain when we come back.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Oh, indeed. Welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group, and here today with me is Alex Monk. I'm a certified financial planner practitioner from Akers Financial Group. Alex, second quarter, you ready to go?
I love it. Let's do it.
All right, so you got some storytelling skills ready. You're warmed up for some stories.
Oh, yeah.
All right, so the question is this: why pay tax now? We try in the first quarter to cover some basic concepts, but just talk about why should someone say, oh, this is a good idea?
Right. So like in your retirement plan, you have so many unknown variables, right? Mm-hmm. The market, your health, your longevity, all these different things. But taxes is a big part of that. So if we know right now that we're in a good tax environment, or we know different things, it's a good time to pay tax. Like historically, we're at some of the lowest tax rates personally ever. Mm-hmm. Like that to me seems like a no-brainer.
Right.
Like our debt's going up.
Right.
We just went through COVID and spent so much money.
Yeah.
They're going to have to get some of that back.
Oh, just let's think about when people do their tax returns, they love getting refunds. And I try to explain, well, it'd be better because we can make money in the bank now. We could actually keep your money and let the government only get what they're owed and then try to hit a zero at the end of the year. But some people like it because it's a forced savings. They like feeling like they don't have to worry about saving for taxes at the end. But when I see a big refund, sometimes I say, well, we can do some Roth and you've already paid the tax on it. It's already incorporated in your budget.
That's always nice because I think people think that when they get a refund, they're getting, they're paying less taxes. Mm-hmm. But
right.
it doesn't impact what you're paying at all.
It's not like you won the game and they gave you a bonus round. Here's some free money for you.
No, that was your money the whole time.
It was your money. You technically overpaid. You overpaid the taxes, and they sent it back to you like a refund of what you overpaid. That's why it's called a refund. All right, Monk, I know you've done this. So a younger client calls you. They switch jobs, and they're pulling money out of their 401k. It's been pre-taxed, and you roll it to an IRA. When they're younger, is it a no-brainer that they should switch to a Roth right away? What do you do with younger people?
I do it all the time.
Okay, explain a little bit how it works.
So basically, like, let's say I have this one client, husband and wife, they both do well. Mm-hmm. They have some IRAs and stuff from previous jobs. They're both maxing out their current 401ks. They save here, there. We've filled up all these buckets of places to save. And now I'm like, well, let's keep more money in your retirement account and let's pay the tax on those outside IRAs right now. And by not withholding the taxes from that account, like most people, one of the big things that we don't like to do is when you convert a IRA is withhold taxes from it. Because you want the maximum amount of money to go into your Roth, meaning the whole account. So you need to have some cash on the outside to pay those taxes.
Sure.
And that's one of the best ways to do it, is not withholding and then using money from the bank or, whatever, another account to pay the taxes. It's essentially like adding that part of the account that wasn't yours back to it.
Now, that couple you're talking about, so they probably switch jobs, have money in an IRA, and then you want to convert a portion. How do you know how much to convert?
So then we look at a tax return, right?
Okay, so we look at taxes, actually look at tax returns, and then we project the current year, right?
Yeah, so we say, okay, what's your income level going to be? Mm-hmm. We usually meet towards November when we have a good idea, like no big surprises coming.
Right.
And then say, all right, we have XYZ left in the 22% tax bracket. Mm-hmm. Let's fill it up.
Yeah, so filling up a bracket, let's explain that too while you're talking about it. So just explain what you mean by fill it up.
Okay, so your tax brackets are banded by income levels.
Sure.
And so when you go from 12 to 22, that's a big jump, but it's not retroactive, meaning all your money doesn't get taxed at your new tax bracket level. It's just the money that you earned at that level.
Right.
So when you say, like, if I'm already halfway through the 22% bracket, no matter what I do,
yep,
and I have another $50,000 of income that'll be taxed at that level before it goes to the next one, that's kind of the target we shoot for.
You're not paying extra or paying any more than you would. You're just paying it now.
Right. Now, the problem is there's big jumps, like I just said, 12 to 22.
Right.
So for some clients, we want to max out that 12% bracket.
Correct.
Like we were talking earlier, if they're not taking all their retirement income yet, like let's say you retire at 60, you don't have Social Security, all these things yet.
Right.
Then we want to max out that 12% bracket because in the future, required minimum distribution, Social Security, you're going to be above that level.
Yeah. So these brackets are like steps. So the lowest one's 10%, then it goes 12, then it goes to 22. At 12 to 22, there's a certain amount of income, taxable income level that you really have to stay underneath to be able to pay that next dollar at 12%. The hardest part is this. You look at your bracket today, and then you look at, well, if you're a successful saver and saved this money and you have your pensions and Social Security all together when you retire and you're 73 or 75 years old and you have to pull out of all of your retirement savings a minimum distribution and you're going to be in the 24, 30% bracket, the hardest part for me is like, well, why would we want to do pre-tax where we're going to just pay more in that future and build up this huge, almost like a debt to the federal government and state government? Why not pay tax now, never again? So the idea is this. Let's say you're changing jobs. You changed a job in the last year and the money's at the old 401k plan. You call us. We roll that out to an IRA. An IRA is an individual retirement account. That rollout is tax deferred because we do it properly with the company. Account rolls into an account that's with us, with one of our custodians, whichever one fits well. That custodian, we then work with them. We set up a Roth IRA account. We can convert the whole thing over to the Roth. Conversion, in the year you convert, you pay tax on the value the day you convert. on whatever you convert. So we can do partials or all of it. So we use a strategy to figure out exactly how much to convert. It then goes into the Roth, and then you're off to the races on the Roth IRA looking for growth.
Tax-free forever.
And the tax-free forever is a really great thing for the younger the people are. Now imagine you're younger and you want to retire a little early. What's nice about a Roth, you can retire on some of the cost bases early, which is nice. So today we're talking about tax-free and use of the Roth, and we're talking about never pay tax again. So never pay tax again, the Roth IRAs have been a great thing to do. One of the things I want you to explain is that when you think to your future, that could be in the next 5 years you retire, 2 years, could be right now. There's a it's something called IRMA. It's the basically income-related monthly adjustment amount. This is where your Medicare premiums are means tested. I had a client this week, and I said, I need to introduce you to a lady named Irma. And they're like, oh, I don't know anybody named Irma. I said, well, not at a diner or anything like that. This is Irma. You're 63 this year. Oh, yeah, I'm not retiring. I said, but 63 in Irma is where they look at how much money you make when you're 63. 2 years later, the first year you're 65, your Medicare premium is based on how much money you make this year.
Oh, yeah.
And they're like, what? And I said, oh, yeah, you're not just a standard. It's means tested. So go with me on this thinking. Means testing of Medicare, how much longer till they means test Social Security? Means is this, how much money you make? How much taxable money do you make? All right, if you're over a limit, let's say it's $216,000 for a married filing jointly, over that, all of a sudden you're going to pay more on your Medicare, 25% more, 50, double, triple, quadruple, all different levels. Get to know Irma. It's all part of the planning, but a Roth conversion does a wonderful thing. It lowers your future income, possibly below IRMA, so you don't pay extra Medicare. So besides saving taxes, it saves Medicare premium. And I believe that means testing is not going to stop under Medicare. I think Social Security could be means tested down the road.
Yeah, and if they do it on income, then you're required to take money out of your IRAs. Mm-hmm. They're going to know.
Absolutely. And that's why converting and making tax-free and setting money up on the side. Now, Roth IRA, we're using that as our example today. There's a whole other shows we do on life insurance that you can put money in there and grow tax-free. If you do that properly and you give it 15 to 20 years to let that money grow, could be another vehicle. We just think Roth IRA should be one of the first ones to examine, especially at your work. Can you save pre-tax at your work? All those kind of ideas.
Yeah, and the nice thing about the Roth is there is no required minimum distribution. Like, they're not coming after anything in that account. Mm-hmm. So you have choices too. Like, one of my favorite things about retirement planning is helping people figure out how, where, and when to take their money out.
Yes, that strategy for income planning comes into the effect of what you did years before. And what we're talking about today is pay tax now so that when you get to retirement, you have choices. Imagine saying, okay, I got a pre-tax account, so that all that money's not mine. I already paid a tax on that one. All right, so give me a little bit out of there, a little bit out of here, and overall you keep your tax rate reasonable, you stay under IRMA, whatever other limit you got to work on, and do magic. Now, I believe this is a great idea to pay tax now, so great that I've talked to a number of executives and large corporations that are clients of ours where we go through with them, why are you doing pre-tax savings in the 401k? And I said, and I explained what a mega Roth is also, but I'm just going to explain with them. I said, you're doing pre-tax savings. You're saving money now at the bracket you're at, which is just in the low 30%. And then you're going to retire. You're going to retire in the same level of income. I can prove that to you with all your savings. And you're going to be in the same bracket. Does it make mathematical sense to defer into a future and pay tax on more money? Or do we go ahead and pay the tax now? Costs you a little bit more money because you are paying tax now. It's real money. I believe that's true. But you'll never pay tax again on that money. And we get some tax-free money down the road for you. Extremely important.
Right. And the other thing is cash flow too, right? Like, retirement's about cash flow. Mm-hmm. Why not pay the tax, which you're going to have to pay one way or another, while you're working?
I like when the cash flow is paying the tax and then later on you don't have to worry about it at all. Understand paying tax now is extremely important. At Akers Financial Group, everything we do is about you. So when we talk about your unique financial fingerprint, do you need to do your taxes, redo your taxes? Do you need to work on this Roth conversion? Do you need to see how if it goes into the plan, the whole plan, where we add value for your whole life by being your advisor? That's exactly what Akers Financial is trying to do. We want to talk about you and what's right for you. It's not the value that you could bring to our firm. It's about the value we can bring to you and your family. That value is what matters. And that's why paying tax now and never again might be the right answer for you. So go ahead and give us a call for a free consultation with one of our team of advisors. Call us at 833-WIN-RETIRE and schedule an in-person or Zoom meeting with one of our advisors. Call 833-WIN-RETIRE. Or 833-946-7384, or visit our website at akersfinancialgroup.com. If you're married or single, it makes a difference. We'll explain in the second half of the show.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I am Brian Akers, President and Founder of Akers Financial Group. Here with me today is Certified Financial Planner Practitioner Alex Monk, also an accounting degree from Towson University, local boy.
Oh yeah, tax guru.
Tax guru. You hit guru level. That's cool. Well, the idea is this. You have to incorporate taxes in your investments, taxes in your planning, taxes in how you save your money. It all matters. That's why I did the show today. This show is called Never Pay Taxes Again. So the idea is in showing you and teaching you about Roth IRAs, Roth 401ks, Roth 403bs, how to do Roth and why it might make sense for you to look at right now and why it's so important to take advantage of this in your overall financial plan. If you missed any of this show, you can go to our website at akersfinancialgroup.com, AKERS financialgroup.com. Hit the Winning in Retirement Radio podcast tab, and you see all of our shows there. You can go back and listen to things over and over if you really want to hear some. We didn't have that many funny stories today, so we've been very
we're
serious.
Just getting warmed up, though.
We've been very serious about this topic.
I mean, taxes are no joke.
Taxes are always there, and the hardest part is using the rules that we're given to pay the tax now and never again is one of the best concepts of how to grow your money to become your money. And I just love the idea. One of the things that we want to go over in the third quarter here is why it's so important when you think about if you're married or single and how this applies and how it makes a really big difference when you look at filing as married or filing as single.
It's a huge deal. I mean, the income brackets are double if you're married. Two people, they give you twice the level of income.
Right. That means you can make a lot more money and pay a certain amount of tax. But whenever a marriage, when one person passes away, the year after, that person has to file single. If they have anywhere near the same income, they're paying a lot higher tax rate.
It's terrible, really. Because when you want your spouse, typically in plans, we want the spouse to have the same amount of income, right? I mean, your lifestyle stays relatively the same.
Yeah, at least 80% of it, 75% of it. But the reality is that your spouse, the widow or widower, is going to end up being at a higher bracket than you ever were married.
Oh, yeah. And if you have two sets of deferred accounts, now you have one set.
Because your retirement accounts combined with the surviving spouse.
And now your required minimum may be at least double.
Yeah. So one of the things that we have done, and I did this a couple of times last year when a client passed away, is what we did was this. We looked at the taxes for the year because that was their final year of filing jointly, and explained to the surviving spouse that I believe it's best to do a Roth conversion to pay. In the one case, we took $80,000 out of the IRA, paid all the tax that year at that bracket, so that we could reduce a lifetime of income taxes. That the spouse was going to actually jump into the 32% bracket if I didn't get the IRAs down. 80 was how I could keep the same bracket without. I couldn't really solve the whole problem, but through doing that is a very important thing. The year of the death of a spouse is when you have to do something like this.
Yeah, and along the way too, that's why we always meet with clients every year, figure out where they're at, max out that tax bracket. But part of that is reducing future income issues.
Yeah. It's one of these things. Life hits us. And so when life hits us as a financial planner, we do think about money and finances and trying to make this money last a lifetime. And we just don't want to give more money than we have to anything like taxes. We want to do better with our money, keep that money. If it's you and your spouse, or if it's just you by yourself, we need to make sure we pay the least amount of tax. So some of the reasons to Roth convert could be because one spouse is older than the other, and there will be years where the other one's going to be single on their tax return. We know it for sure because of the math.
Typically, you got to play these numbers. I know it's not fun to talk to people about that, but it's like at some point there will be just one of you.
I had a guy in the other day, he's 80 years old, wife's 73, 7-year difference. Women usually live 3 to 4 years longer. That's 10, 11 years she'll be by herself when it comes to financial planning. And the idea is, well, with this all slides into her name, all of a sudden she's going to be at double the tax rate. They were only at 12% in retirement. All of a sudden she's in the 22, which will become this new 25 bracket in 2026 when things sunset. So the idea right there was, let's convert for both of your future. You pay tax now. We're not crushing the tax bracket. We're not trying to jump too far up. You have some extra money to pay the tax. It just is a good use of money to pay tax now and never again, especially in a case like that with an older spouse.
Yeah, and then the other thing about being single is that your Medicare limit gets cut in half too.
It does. That's Irma. You're talking about Miss Irma again. Yeah.
She's still there, and she just gets a little bit meaner.
Yeah. If you don't know what Irma is, if you make over $200,000 and you're over 63, you're going to meet Irma soon. And that's for married filed jointly. If you make over 109, 108 in single, you're going to pay it.
And like it's not a fun thing to talk about death, taxes, but all of these things are certains, right? Like they're facts in retirement planning. Like we have to deal with them.
Oh, the craziest thing is that more people retire single than married. That's the reality of retirement. Who's retired is there's more single than married. And so we have to know these tax brackets. Paying tax now. It's almost like if you're working right now, hey, change it to pre-tax. No, don't change pre-tax. We don't want pre-tax, do we? You caught me. I think we're really smart to not be pre-tax. What you got to do is after tax. That means you're going to take less money home. You put $100 in, you got to pay the tax. You take less money home, you pay the tax now in your 401k, and this money grows tax-free. Very important.
Right, but if you're getting a match, that match is always pre-tax as well for now. So it's not like you're going to solve all your issues, but you got to know, okay, hey, where am I going to be income-wise? We want to pay. If we could keep ourselves in a good tax bracket and levelize taxes for life, that's also very ideal. Saves you from those big balloon years, because once your income goes way up, there's waterfall effects like Irma, all different types of things happen.
Oh, my goodness. When it comes to Roth conversions, when you're drawing your RMD and you're fully retired, you still can convert. One of the things I did last week was I had this client, we gave away their RMD, which was $30,000. So
you mean you gave it to charity?
Gave it to charity. So that means it's not taxable. And then we converted more money that was taxable at their bracket. So they did their full charity for the year, and we converted some money under the bracket number and got money to the Roth.
People are always shocked when they're like, well, I'll just wait till my required minimum and then I'll take that and convert it. And it's like, I can't do that.
Yeah, you cannot convert your RMD, but you can give it to charity. Whenever you have tax seasons, you have accountants arguing with my clients about the usefulness of qualified charitable distributions and Roth conversions. And basically, most accountants, their goal is to do well on that return that year. They're trying to give you the most refund, the least amount of money. Some people even guarantee the highest refund as a way of marketing. But the hardest part is this. Do you really want that? I don't think so. I think we want to pay the fair amount of tax, the right amount of tax, and then never again. And that's what Roth does for us.
Right. And knowing these numbers is so important, because if you're right on that bubble level, right, where pre-tax will drop you from 22 to 12, that's a big deal.
Right.
But if there's no way of going one way or the other, then we need to maximize wherever we're at.
I had this one case where we did a qualified charitable distribution, and that lowered their IRA income just enough so that the Social Security wasn't taxed. Then when standard deductions slid in, they end up with zero taxes. And then the accountant says, oh, you didn't need to do the QCD because you you don't owe any taxes. And I said, just simple as if you didn't do the QCD, boom, your taxes went up because you pay tax on income and Social Security. It starts to roll up fast.
Very quickly. And that's the thing. It's like some of your Social Security could not be taxable if you do this planning right. Or you could have a real nasty surprise when you turn 73, 75 to where you're used to not paying any tax.
Absolutely.
Take this huge withdrawal. And now it's like, wait, I have to pay tax on that now? What happened?
Yeah. So if you're a saver and you're trying to grow your money over time, and I believe savers are going to be very successful. We have many clients that have just done incredibly well. It's neat when we grow from 1 to 2 million, 2 to 4, and 4 to 8 million. The hardest part, if it's all pre-taxed, it's a great growth rate, but it's a tax problem. So creating your own tax problem in some cases like that with good growth in a stock.
Yeah, but you're going to have to pay the taxes one way or another.
Yeah, and
I'd rather do it on our terms.
Yeah.
Like
you decide when, you decide how much and when based on that, right?
Yeah, and we know the rules. Like what scares me the most for people, especially the ones that are done well saving, they're going to be the targets for all means testing in the future.
Absolutely. So the idea of this, never pay tax again. So on a Roth IRA, you pay tax as money goes in, and then it grows over time tax-free. I try to tell people when they're retired that if you make any money at all, we can contribute to a Roth IRA. So instead of saving it in the bank, save it in a Roth IRA, it gets tax-free growth. And that's a good thing.
I have so many like 70-year-olds that come in at the, this time of year, like April-ish, with their W-2 from last year. They're like, look, Alex, I got $4,000 in change. Let's put it in the Roth. Right.
So you look at your W-2, and that's actually the maximum that you can give to a Roth IRA. For 2024, the number is $8,000. If you're over 50, it's $7,000. If you're under the age of 50, and if someone makes $7,000, they put $7,000 into a Roth. If they make $13,000, they can put $8,000 for them and put some money for a spouse. Once they get over, if they're both over 50, and once they get over $16,000, you can't put any more than $16,000 between two spouses.
But it's a good thing. I mean, every little bit helps.
The reason we're talking about this is we know taxes are going to change after 2025. That's going to sunset into the old law, and that brackets will go up. And then we think now is the best time to pay tax. So pay tax now and never again. At Akers Financial Group, we're local. We're independent. We don't report to a big company on Wall Street. We report to you. We have offices in Lutherville and Forest Hill, clients like all around the region, all around the country, and even a few around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your free meeting with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. Warning, when it comes to a Roth conversion, don't try this at home. We will talk about that when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. I'm Brian Akers, and we welcome you to the fourth quarter of Winning in Retirement, a radio podcast put on by Akers Financial Group. Co-hosting with me today is Alex Monk. Alex, you ready for the fourth quarter?
This is the time, Brian.
Fourth quarters are wonderful to watch. We're not going to call a lot of time out, so it's not going to extend the time. We're going to be all right here, right?
Got to finish on time.
Absolutely. We got to finish before the buzzer. So winning in retirement is where we make decisions that are going to help you win now and throughout those retirement years. So no matter what age you are, winning should be on your mind. When you're working hard for your money, let's make your money work hard for you. And that's why you must consider paying tax now and never again. So the idea of the show today is never pay taxes again. How do we do that? We're talking about portions of your money that you can put aside into something called a Roth IRA or a Roth version of your retirement plan at your work. This fourth quarter, we put a warning sign on this quarter. And that warning sign is this. When it comes to Roth conversions, don't try this at home. All right, so Alex Monk, you're here for the fourth quarter, and we have a warning sign. Why should people not do this on their own?
So there used to be a way that you could go back and undo your Roth conversions.
All right, so you're hitting the number one reason right on the block.
But you can't. You can't go back anymore.
So if you convert and then go, oh, I didn't mean that.
You meant it.
Or if you converted the whole account and you only meant to do partial, you can't.
So you just can't go backwards anymore. They used to give you up until like October of the following year. You could go back and
redo.
I don't want to do that, yada, yada, yada.
So you have to know your tax plan to be able to make sure, and you got to fill your paperwork out right to make sure you're doing it right.
Right. Make sure it's right before you hit that button, or have somebody that's done it before, like us. Like we do this all day.
Yeah.
You can there is a way with Irma that she'll forgive you if you go over your earning limit.
Right.
But you get one time to do that.
Right.
But you can't go backwards on the Roth. So you need to know this is what I want to do. And that's why we typically do them around the end of the year once we know all of our income. Like you don't want to do it beginning of the year and then life happens.
Yeah.
Some giant income, I don't know, whatever may happen. Not a good thing.
All right. I had a trick question for you. So I'm telling you it's tricks just so you can just play along. You already know all the answers, right, Alex?
Well.
All right. So the question is this. I have a small stack of money and a large stack of money. Which one do you want to pay tax on?
The small stack.
Okay. Do you know that in your 401k, you pay taxes on the large stack when you retire, not the small stack? You're taking a deduction for your contributions, and then you're investing it. Some people are watching that investment all the time, growing it and growing it. They're becoming 401k millionaires, TSP millionaires, growing these assets and been in the market and doing really well. And then all of a sudden they realize, oh, I got to pay tax on my large stack now. The decision on where you contribute your money, how you contribute, matters most when you're successful with your investing and you've grown it, and now all of a sudden you have an issue.
Yeah, I mean, Uncle Sam's he's watching that account grow. I mean, they find out, the IRS knows at the end of every year how much is in your retirement accounts.
They're not being sneaky like Santa Claus, who knows if you're sleeping or not. But the idea of the IRS, they get a form called a 5498 where your retirement accounts send them the values of your IRAs, how much you put in. All of that gets into their system. So it's money that's available, and the information is available to them.
Yeah, so it's going to be there and it's going to be taxed. So you have a partner in retirement and you want to get them out of your account. You want to get his hand out of your pocket as soon as you can.
All right, let's do some basic accounting when it comes to doing a Roth conversion. Now, some people that do their own Roth conversion do their own taxes too. Now, when they come in and they said they Roth converted, what is the form you look at to see if they Roth converted properly?
Well, first you got to make sure they have the 1099-R listed.
Yeah.
But then you got to pull some forms in the back and look for this 8606.
8606. So it's like a 8606. That's an actual form that we have to fill out on the tax return the year you do a Roth conversion, which is a retirement money IRA, typically to a Roth IRA, that transaction.
Yep.
1099-R shows the value on the day of the transfer, and that's taxable.
Correct.
We don't want withholdings on that. We want to pay the tax separately through withholdings or paying a quarterly estimate inside that.
Just pay an estimated tax payment based on the amount of you converted in the quarter that you did it.
So the form 8606, what is that?
So that form tracks all types of different stuff.
Okay.
It tracks IRA contributions, and it also tracks the tax deductibility of those IRA contributions.
Sure.
Because in the case where people are listening and they're like, "Well, I make $300,000, I can't contribute to a Roth. This doesn't matter to me."
Right.
But it does, because if you make a non-deductible contribution and then you convert that to Roth, you don't pay any tax.
That's called a backdoor IRA or backdoor Roth, really. But you start out with an IRA that's non-deductible. So that means you put in after-tax money into a regular IRA. Then after it hits there, you convert it because there's no income limit on Roth conversions from retirement account to a Roth. And then you convert it over. But your 8606 form, you say, this is how much I converted, but I have a cost basis, and they offset each other. You end up with a zero taxation.
Right. And that's assuming that you don't have other IRA money.
And typically we don't do backdoor Roth IRA, the concept at all, if there's any other IRA money.
Right. Unless it's the plan, let's do it and then convert the whole thing this year.
Right. So the idea is this, it gets sophisticated, and their warning is this on the Roth conversion: you got to do all the paperwork, the transfer properly, and then the tax filing properly. And then you must track this cost basis to your future to the nth degree, because you are the one telling the IRS that, oh, I don't pay tax on this money when I pull it out, because the IRS is going to say, oh, we forgot about that one, but you owe us tax.
And there's also the 5-year wait on your conversion as well.
Yeah, explain that a little bit better.
So when you pay tax on an IRA and it goes to a Roth,
Sure.
that starts the ticker for a 5-year period where you have to hold it to make sure that when it comes out, it's penalty free.
Okay.
Meaning, if you take it out before then, you might have to pay an early withdrawal penalty.
Right.
You don't want to do that.
Okay. But a Roth conversion, every Roth conversion has a 5-year wait, and that's why you have to put that on your form, the 8606 form.
Right.
Let's say people have never done 8606 form, and then they need to fix it in the past. Can that be done?
It can. So the 8606 can be filed on its own. It has a signature spot on the bottom. So if you're like, hey, I did this, that, and the other this year, and I didn't tell anybody, you can fill out that form, sign it, send it on in.
Yeah, and the idea is that's what we have accounting firms for, and that's what we use them for, to get all the paperwork right. Because the idea is this: when you put money in a Roth, you want it to be tax-free. You don't want anything to catch on the back end. You don't want to do the paperwork wrong and not be right.
No.
Some of the hardest parts is when people try to Roth convert after they're drawing RMD. That's a major mistake that we've seen. But the idea that is this: Roth conversion is taking pre-tax money and paying tax now, putting it into a Roth and letting it grow. It's not for money that you're going to be using in the near term. It's for money down the road, money you might not need, money for your family, because they don't pay tax on it either. In some cases, we have clients that receive a beneficiary Roth. That's wonderful. It's a tax-free account. One of the things we're doing recently on a beneficiary Roth is you have 10 years to take that money out. We're taking that money out to help to find other ways to save it. One of the ways is we pull it out of the Roth, that's tax-free withdrawal, and we're funding Roth IRAs for the person that inherited it.
Right, and then you just defer that, no taxation forever for that person.
For the rest of their lifetime, even to the next generation. So the use of Roth IRA, the use of Roth through your work is like a very, very important piece that you need to know you're doing it right. You need to know for sure that you have done things the way that would benefit you today and to the future.
And based on what your plans are. Like I have a lot of clients that have so much other income retirement money where their Roth money is just to give to their kids.
Correct.
So that account's invested like it's for the kids.
Absolutely.
So it's more aggressive. It's that long-term money. But we know, because we have that plan, right? We got to have that plan together so we can understand, what am I doing and why am I doing this?
The why and the purpose behind any type of planning benefits us for a lifetime. That's what we're trying to talk about by winning in retirement. Winning in retirement is not a quick little thing where you buy this or and then you're done. You really got to manage who you are and what you are. We call that your unique financial fingerprint. That's where you are today. And yes, we need to look at information to do calculations on all this type of planning and project the future as we see it and try to pay the lowest amount of tax.
Right. And, we can't predict the future, but there are certain things that we know, right?
Yeah.
Longevity is a question mark.
Yep.
Volatility, taxes, all these things are huge question marks. So let's figure out where we are today, what we know today, do the best thing, and then when the rules change, we got to adjust.
Now, we can't wait to meet you and have you come into our offices, meet with one of our advisors, and you start out the conversation like this. Hey, I never want to pay tax again. That just give us those code words, and then we'll begin the concept and walking through all the ideas behind how a Roth contribution or Roth conversion can work for you and your family.
And sometimes we got to take 2-3 years to get that plan in place. Like if all your money's pre-tax, well, I might have you take an IRA withdrawal and just hold it in cash so that we have money to pay the tax the following year.
Yep.
because we got to have that balance at different places to pull from. Because like you said, if everything's in a pre-tax account, there's only one way to get it out.
Yeah, it's paying the tax. So imagine this. We're not telling you not to pay tax. The word never pay tax again implies that we can find a way to pay tax once and not again. That's the Roth IRA and the Roth 401k, Roth TSP, all those ideas, getting them all to your future, taking this money and growing it. So you save this money. It's your money. You get to use it. So today we covered never pay tax again. So what we recommend is you pay tax now and never again under the Roth. Thank you for a good show, Alex.
It was fun, Brian.
Glad you could keep rolling with me the whole time. It was fun. I like that a lot. We look forward to meeting with you and look forward to having you check us out on our website at akersfinancialgroup.com. We also want you to win in your retirement, so take advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Arcadios Capital, an SIPC and FINRA member firm. Advisory services are provided through Arcadios Wealth. Akers Financial Group and Arcadios do not share any common ownership. Neither Arcadios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.